Welcome back to the afternoon session, and it's my pleasure to introduce next speaker, Alfred Lehar. Alfred is Associate Professor in Finance at the Haskania School of Business, and he's been there since 2015. He received an undergraduate degree and PhD from University of Vienna, and prior joining Haskania, Alfred held positions at the University of Vienna and at the University of British Columbia. He teaches an introductory finance for MBAs and a class on corporate finance for PhDs. And his areas of research include fintech, bank regulation, financial stability, corporate finance. He's currently researching mining fees and price differentials in Bitcoin markets, decentralized exchanges, and under what conditions renegotiations can facilitate the private sector workout of a financial crisis. He also works on how information produced by financial markets can be optimally used in banking regulation. And in his previous research, Alfred developed several methods on how to measure the probability of financial crisis, analyze conflicts of interest for financial analysts, and looked at the empirical fit of alternative option pricing models. Alfred's work has been published in the Review of Financial Studies, Management Science, Journal of Financial Intermediation, Journal of Banking and Finance, and in the Review of Finance. And today he's going to present a paper on systemic fragility in decentralized markets. So Alfred, the floor is yours.
Thank you so much, and thank you for having me, and thanks for the kind introduction. So let me just share my slides. And I cannot really see the chat when I put this on full screen. So please interrupt me at any time. I know that kind of in mathematics, it's not custom to ask questions during the talk, I think, in some places, but I really like questions as we move along. So I'm totally used to that. So please feel free to interrupt at any time. Okay, so this is joint work with Christine Parlour from UC Berkeley. So there's a lot of work that's been done on contagion and systemic risk in the banking sector. In the aftermath of the financial crisis, and I've done a little bit of work in that, but there's almost no work in DeFi markets on this issue. And why is this interesting? Well, in DeFi, we have some unique characteristics that are missing in the traditional financial system. So capital can move freely. As I'll talk soon, we have some new innovative tools that allow us to overcome capital constraints. So there's new innovations that don't exist in traditional financial markets. And all the information pretty much is on chain that we have. So it's an interesting informational environment. So I cannot see, for example, how many loans of Citibank are under collateralized, but on the blockchain, I can totally see everything. And so we have a lot of price information on the chain. Everything is drawn from the chain. So in a sense, it's kind of a closed information system. And finally, there's no regulators here. So we don't have a government that can come in and do a bailout. We have no circuit breakers, no lenders of last resort that can lend money to troubled financial institutions or lending platforms. So there's nothing like that. So we really see how would a financial crisis or how does contagion unfold in such a world that is completely unregulated, where anybody can do anything that they want. So we look at collateralized lending in DeFi, and this is the largest actual application of DeFi. So most of the money is tied up in these. So we have about $53 billion tied up in various DeFi lending pools. We look at two platforms in our paper, two large platforms, Aave and Compound. And the last time I looked, they had about together roughly $20 billion locked up in their ecosystem. So what we want to document in this paper, and this is very early work, so we're still working on this, we want to show that there's systemic fragility in these lending platforms. So specifically, we have these negative feedback loops where under-collateralized loans get liquidated, then the collateral often gets sold immediately, and this creates a downward pressure on the price of the collateral. So if the price of the collateral decreases, more loans are under-collateralized and more loans get liquidated, and collateral gets sold, puts price pressure, and we see kind of these feedback loops unfolding. So this is one of the main reasons why regulators intervene in a financial crisis, because they're afraid of these kind of fire sale scenarios where a lot of assets get sold. And so here we can see this really unfold without any regulatory intervention. And we can also trace who is selling what on the blockchain. So if somebody liquidates a loan, if Citigroup liquidates a loan and sells the collateral, I cannot really see that. I cannot trace that back to Citigroup here. So here in this blockchain world, I can really see what everybody's doing precisely and how this unfolds. So for the institutional setup, let me quickly present a little bit on how these DeFi lending platforms work. And please feel free to interrupt at any time if there are any questions on this. So you give, as a user, you give some collateral to Aave. So in this example, we put as collateral 11 wrapped ETH and deposit that with a lending platform. And then we can borrow against that collateral some kind of other cryptocurrency. So in this case, you borrow 1 wrapped Bitcoin as a loan. So the value of this collateral always has to exceed the value of the debt, because in this kind of world, the lending platform doesn't really know who I am. I'm just an anonymous Ethereum wallet address. And so there is no under-collateralized lending or uncollateralized lending that works in a traditional banking system, because the bank knows who I am and where I live, and they can send the police to my house or debt collectors. But in this world, we don't really know who's behind an Ethereum address. So we always have to make sure, these lending platforms have to make sure that the value of the collateral is more than the value of the debt. And so typically this is a factor of 1.2. In many ways, we can see this as being similar to the repo market or to a margin account. So I deposit some, I can use in a margin account, I can use the stocks as collateral. I can borrow more money against these stocks, and then I can use that money to buy more stocks. So similar use case is often true in this kind of DeFi world, where a lot of people take levered positions in a cryptocurrency by posting that cryptocurrency as collateral and then borrowing more dollars against it and buying more cryptos. So several potential reasons why somebody might want to do that. So what happens if that loan is under collateralized? So what happens if all of a sudden the price is such that that the loan does not meet that collateral threshold? So let's assume, for example, that 1 wrapped Bitcoin is worth 10 ETH. And so all of a sudden this loan is under collateralized because the debt value is 10 ETH, but the collateral is 11 ETH. So that's less than 1.2. So the loan is underwater. So what happens? These platforms rely on liquidators, and anybody can be a liquidator in this kind of markets. So the liquidators just enforce the fact that the loans are always properly collateralized, while taking advantage or liquidating any loans that are under collateralized. So it's kind of different than traditional banking, where the bank enforces that there is enough collateral, or your broker, if you have a margin account, gives you a margin call and ensures that there is enough collateral in your brokerage account. So here we are in a different world. the enforcement is done by outside third parties, liquidators who can come in and they obtain a profit. So this liquidating this loan is still profitable because we've made the assumption that 1 Bitcoin is 10 ETH. So if I repay the loan and take out 11 ETH, then I still make money because the loan costs me 10 ETH and I get 11 ETH as collateral. So that leaves a profit for the liquidator of 1 wrapped ETH here. Okay, so where does the liquidator get the money from? So what if the liquidator doesn't have enough capital to liquidate the loan? So here is an innovation in this DeFi space, which is called flash loans. And this is interesting because you can borrow almost arbitrary amounts of money for an instant of time without any collateral. And why is this possible? Because in Ethereum and in any kind of, in most blockchains, a transaction is what's called atomic. That means either the whole transaction goes through or the whole transaction fails. So if I, at the beginning of transactions is a sequence of actions that I do, a sequence of interactions with these DeFi protocols. So everything that is on the slide, for example, is a transaction. And so if I borrow at the beginning of the transaction, and then I do my loan liquidation, blah, 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 and then at the end I repay my flash loan, then the lender can be sure, the flash lender can be sure that they get their money back. Why? Because only the transaction can go through as one piece, it's atomic, so the lending event only happens when the repayment happens as well. So therefore there's no credit risk, and so the flash lender is happy to lend me the money for an instant of time, just to alleviate that capital constraint for that moment. So I go and I flash borrow a wrapped Bitcoin. I use that wrapped Bitcoin to repay the loan. If I repay the loan, then I get the collateral from the lending platform. I keep the liquidator then keeps 1 ETH as profit, takes 10 ETH, sells these 10 ETH on a decentralized exchange, and then swaps these 10 ETH for 1 wrapped Bitcoin and uses that 1 wrapped Bitcoin to repay the flash loan. Now there is, of course, a little bit of fees along the way that I kind of missed out on purpose in this slide, so that the real profit of the liquidator is not exactly 1 ETH, but it's slightly less because you pay some fees along the way. But in general, this is how these liquidations work. Now, we could see different kind of variants of this. So suppose if the liquidator has enough capital and is not capital constrained, we don't need the flash lender. So that's an optional thing. Also, the liquidator is not really forced to sell the collateral on the DEX. So the liquidator could keep the collateral if they want to and do whatever they want. But all this happens, all this loan liquidation happens in an instant of time. This happens in one transaction. So this all happens at in one piece. So why is this kind of mechanism here that I just outlined concerning? So the liquidators, indeed, and I'll show you in the data, often sell this collateral immediately on a DEX. So, and this puts some price pressure on the collateral price. So the price of the collateral goes down, but this not only has a price impact on the exchange where the liquidations happen, but we also see a price impact on other exchanges, even these exchanges where the collateral does not get sold. And so this means that all the prices on all the exchanges go down. And these exchange prices are used for so-called oracles. So if a lending platform needs to decide, is this loan under collateralized or not, they ask these oracles, which are essentially different decentralized exchanges in this fintech ecosystem. So if the prices on all these exchanges are now lower because the liquidator has sold the collateral, now these oracles tell the lending platform, hey, the price of this collateral has now decreased. So the collateral value goes down. These lending platforms say, okay, now the collateral value has decreased, so maybe more loans are up for liquidation. And so we see this kind of cycle happening. When more liquidations happen, this has a price effect, the oracles update, and the collateral value goes down. So we want to look at this empirically. So we want to look at liquidations that happen on these two large lending platforms. We have data between September 2018 and November 21. So we have about 24,000 liquidations in 38 different collateral tokens and 40 different debt tokens. So these liquidations are not small. So we have about $1.3 billion worth of loan liquidations. But on average, there's a lot of small ones in there too. So the average liquidation is $66,000 and the median is $2,000. So the largest one that we have here is $50 million worth of DAI collateral that were liquidated on Compound in 2020. So if you want to look at these exchanges, we look at token trades on these decentralized exchange platforms. So the most prominent one is Uniswap, but there's also other ones, SushiSwap, and we look in the paper at a total of 6 other Uniswap V2 clones that are used for selling collateral. So just to give you an idea about how the data looks like. So here are the most prominent collateral tokens. So this is ETH, this is Bitcoin, and we have a little bit of stable coins here, but by far the largest one are ETH and Bitcoin. And this is kind of the idea. What I was kind of reading anecdotal evidence from is that people use these lending platforms just to build levered speculative positions in these cryptocurrencies. So you deposit your wrapped ETH as collateral, and then you use that to borrow more stable coins, use the stable coins to buy more ETH, and so you can build up a levered position in ETH. So here are the most popular token pairs that are in our liquidation sample. So the most popular ones, as you can see here, follow this use case. So we have wrapped ETH and wrapped Bitcoin here as collateral tokens, and the various stable coins here as debt tokens. These amount to quite a lot of liquidations. So just in wrapped ETH USDC alone, we have $229 million worth of liquidations, and we observe about 2,800 liquidations in our sample. Okay, so let me finally talk a little bit about how we measure price impact on exchanges and why this blockchain setting is really unique to measure this. So most of these liquidations are sold on a decentralized exchange. And you might have used yourself Uniswap or one of the similar ones, or might know how they work, but it's just a little recap on how these decentralized exchanges work. So here is an example where we have a decentralized exchange or a liquidity pool with 2 tokens. So we call one token ETH and one token to make it simple. And suppose now that the pool is at this point where the inventory in the liquidity pool is a certain number of ETH and a certain number of tokens. So that's kind of where the red dot is here. Now, what is interesting, the way these exchanges work is that after every trade, the product, the new kind of inventory that comes post-trade has again to be on this bonding curve, which is this kind of black line here, and that is determined by a mathematical function that is pre-specified. So you know exactly if you sell tokens to the liquidity pool, so let's assume you sell here this amount here along the x-axis of tokens to the liquidity pool, so the inventory of tokens in the pool increases from T0 to T1. So if I sell tokens to the pool, there's now more tokens in the pool. How much ETH will I get back? Well, we can determine that graphically. I say, okay, after so many tokens have been sold, we are at this new point T1. I follow the blue line, and I see here along the y-axis how much ETH I get back in return for selling my tokens. So why is this interesting for our case study or for our research question? Because we can observe exactly how much inventory is in these decentralized exchanges at the time of liquidation. We can observe what these liquidators do if they sell their tokens on these decentralized exchanges. We can exactly compute the price impact. So the price is always given by the ratio of ETH to tokens. So that gives you a price. And so we can see that the price obviously here changes after the trade. So here the price is E0 over T0, and here at the blue point, it's E1 over T1. And so we can compute the price impact, and we can trace everything because of this deterministic nature of these decentralized exchanges. So here's an example of what we are trying to do in this paper, document in this paper. So this is a wave of 180 loan liquidations of the Link token in May 21. So we can see here in this graph, it's a pretty busy graph. So we see here the block height on the x-axis, and we see here in gray the amount of links that was liquidated. So that goes with the right axis. So the gray area shows you that there was one loan liquidation right here at the beginning, then nothing really happened. There was another kind of liquidation here, and then boom, we see this huge wave of liquidations coming in here. So there's all of a sudden, there's a lot of loans that are being liquidated, and then it kind of tapers off towards the end. So in total, as I said, these are 180 loans that are liquidated on that day within a few blocks. So what does this do on the price? So here is most of these liquidations were actually sold in sushi swap. So that's the blue line. And you can see here that that as these loan liquidations gear up, so we see this here in the first little blip, the price drops on these exchanges because the liquidators sell collateral. And really gets big here when the wave really starts hitting. So then we see that the price of the collateral drops. We can see how much of that collateral decrease was really due to the actual trades by these liquidators. So we look at each individual loan liquidation. We look at, did they sell the collateral on a decentralized exchange? And if so, we can compute how much has the price decreased because of the liquidation that the liquidation sale that these liquidators did. So we can really tease out how much they contributed to the total change in the token price. And that's the red line. So we see that initially, when there are no liquidations, the line is of course flat because then there's no contribution from the liquidators. But we see here that in this liquidation wave, when this big wave hits, that a lot of the price drop can be explained purely by these loan liquidations. So they explain a lot of the big decline in the price. What we can also see is that at some point in time after the price has dropped, somebody else was buying. So these liquidators were still selling, and they would have pushed the price further down, along this red line here, but there were other traders coming in and they were buying because the price of the collateral has decreased a lot. So this probably saw a good buying opportunity. So the actual price that we observe in the exchange, which is again the blue line, did not change that much. The last interesting bit we can see out of this graph is that there is contagion to other exchanges. So most of the loan liquidations here in this wave were sold on SushiSwap, but the price on Uniswap also followed suit. And so that's the orange line. So we see that the price on SushiSwap, on Uniswap pretty much follows the lead from SushiSwap and also drops. There's even a contagion to the traditional financial system. So with the green line is the price on Binance, and Binance is completely unrelated to this whole thing, right? So Binance, there's no loan liquidations. You cannot do any you cannot sell those collateral that you obtain in the loan liquidation on Binance because it's a centralized exchange. So you would have to, it would not be possible to do that. And we still see that the price on Binance drops. So this is kind of interesting because we really see that this contagion happens across markets, even markets that are kind of somewhat detached from the decentralized finance universe here that have a very different market structure. So when I was presenting this to some regulators, they were concerned whether there was the potential for spillovers in from the DeFi ecosystem to the traditional financial ecosystem because of this. And we kind of see that this could be possible in this graph. Okay. So as I said, we want to look at some at liquidation waves, and the way we define a wave is if liquidation is part of a wave, it occurs within an hour after previous liquidation on the same collateral token. We find in our sample about 580 waves, and they have at least 5 liquidations in them. These waves, in these waves, about 13,000 loans are liquidated. So some of these waves are pretty big. So we have at least 8,600 liquidations that have at least 20 liquidations in them. And then the biggest wave, 740 loans were liquidated. So the average wave is not that big. So we only have 5 liquidations in 2 hours, but there are some larger ones out there. So why do these loans occur in liquidations? Why are these thresholds clustered? It's a good question. Probably because at some point in time, this was the lower bound of, or a local minimum in the price. And then people started borrowing and building up levered position, and the price went up, and then when it comes down, it hits that kind of threshold. But that's just speculation. We don't really know why these thresholds are so clustered around similar liquidation thresholds. So here you see a little bit how these liquidation waves look like in our sample. So on the right-hand side, you see the weekly liquidations in US dollars. So you see here in the biggest wave, there was about $550 million of loans liquidated, but there is a few of these fairly sizable waves in the sample. And the red line shows you the ETH US dollar price. And you see that whenever there is a liquidation wave, the value of ETH drops a lot against the dollar. And that is mostly because a lot of these loans involve ETH as collateral. And so if the loans get liquidated, the collateral gets sold, the value of ETH goes down. So who are these liquidators? So, sorry, we observe about 950 different liquidators, and that's not, of course, truly liquidator. We just observe wallet addresses. So a liquidator might have multiple wallet addresses. So at most we have 946 different liquidators. Maybe it's fewer than that. But even amongst those fairly small number, liquidation is very concentrated. So the top 20 liquidators do about 40% of the liquidations and liquidate 80% of the collateral. So the top liquidator in our sample liquidated 1,400 loans with over $220 million. So this is highly concentrated and specialized business. So we can plot here the liquidation amounts by the top liquidators. So these are the top 20 liquidators. And you can see that even kind of after the drop 10, it kind of flattens out, and these are kind of less important. So what also is interesting to see here is that these liquidators seem to specialize in various platforms. So we have Aave here in blue and Compound in orange. So the largest liquidators, the more successful ones, seem to focus on one kind of platform. There are some loan liquidators that do both, but they are generally smaller in size. So if you take this ranking and preserve that ranking and look here at the number of loans that are liquidated by these same liquidators, we see a similar picture that liquidation activity is fairly concentrated. The top two liquidators not only liquidate the largest amount of loans, but also the largest number of loans. Okay, maybe I should stop here before I move to the analysis and see if there's any questions so far. Okay. Oh, yeah.
Hi, Alfred. Just a quick question. Maybe I missed it from earlier. I was just wondering what price is being used to determine when the collateral constraint is violated?
That's a very good question. The answer is we don't really know. So these lending platforms keep that information close to their chest. To avoid on purpose manipulating that people manipulate the price on some of these decentralized exchanges. Some of them seem to query multiple dexes. Some of them might use a service like Chainlink to update them on the price. So it's a little bit unclear. But that is a very interesting question. We should be, would be nice to know that. Okay. Any other questions? Okay, so we then take a look at what drives the likelihood of actually using a swap in the loan liquidation. So as I said before, when I showed you this kind of graph at the beginning, some of these steps are optional. So we don't really need a flash loan. We don't really need to sell the collateral on the DEX. If the liquidator has enough capital, they can also just repay the loan and keep the collateral and just, I don't know, hope that the collateral increases in value again. So I don't know, there's different strategies. It doesn't have to be sold. So, but we do see that when is a swap used in the liquidation is increasing in the amount of collateral that's being liquidated. So the larger the loan liquidation, the more likely it is that you might probably use a flash loan. And in that case, you have to swap the collateral immediately so that you that you can repay the flash loan. So when do more swaps get used? In large waves and in short waves. So in liquidation waves that are large and short, we see that there is a lot of swap use. Well, that leaves a little bit up the question of causality here, and we don't really know what to say there. So is it that the wave is short and big because swaps are used and that pushes the prices down, and so more loans get liquidated, and is that because swaps are used? Or is it when the wave is large that these liquidators want to swap immediately so that they can reuse their capital and liquidate the next loan? Kind of unclear. Oh, we don't know, but there is at least a correlation between those two. Larger liquidators seem to use swaps more often, probably because they are more professional. And when the gas price is high, we see that there's less use of swaps, probably because the swap adds another step in the transaction, and therefore that takes up additional gas, and so you pay a higher fee on the blockchain for that. So to see if these loans have some kind of price impact, let me show you again a motivating example. So here we have a liquidation of $20 million worth of Bitcoin collateral in 21. And so this loan was liquidated and the proceeds were swapped on, the collateral was sold on SushiSwap. So here we see the price happening. So at this point in time here is when the loan liquidation happened. So this is block by block data, so you can really see exactly what's happening. So if you see some kind of strange vertical bar, that's because that happened within the same block. So we see here that the price drops very much on SushiSwap because that's where the collateral was sold. And people then figured out, hey, there's now a much lower price on SushiSwap because of that collateral sale, but maybe that is just because of the sale, and maybe that doesn't mean something. So people start kind of buying back, and on the other DEXs are affected. So we see that the price here on Uniswap and DeFi swap kind of drop, and then a new kind of consensus price emerges afterwards. But what is interesting here is that there is a lasting price impact. So this was the price level before the liquidation, and then the loan liquidation happens, and there's a little bit of kind of arbitrage activity or unrest happening here in the middle. But what we see is that there is a lasting price impact. So because of this loan liquidation, the price of red Bitcoin dropped from 31, that's the price per 1,000 ETH. So it dropped from 31.2 to 30.6. So that's quite a large intraday drop that we see here. And that was not short-lived. So it lasted for at least here 20 minutes, roughly in the data. So that is enough time so that all the oracles update and then say, okay, now the red Bitcoin is worth less than it was before. And that is enough to push more loans into liquidation. So we look at this in a regression format too. And what you see is that these liquidations do have a large price impact. So we look at the return over the next 5 blocks after the liquidation, and we look at the exchange where the loan was liquidated. So that's the right 2 columns here. And we look at other exchanges where there was no liquidation. So if the main variable of interest here is the return of the liquidating swap. So we see how much does this swap explain in the long-lasting price impact that we see, or in the kind of medium-term price impact that we see after the liquidation. And so the number here for the DEX where the swap was liquidated is smaller, and it is much larger here for the other exchanges. And that is because, as you can see here, whether the swap was liquidated on the orange exchange on SushiSwap, we see that there is a big drop in price, but then there was pushback. So arbitrageurs then brought the price back up to kind of the new equilibrium price level. So therefore, the return of the liquidating swap is much larger than the long-term price impact. And that gets reflected in this kind of smaller regression coefficient. Versus on the other exchanges, a lot of the drop was much smaller, and a lot of that drop is attributable to the return of the liquidating swap. So we also see that the gas prices play an important role here. So in the impact, the return of the liquidating swap has a larger price impact when where the liquidation on the exchange where the liquidation happened when the gas price was high. And the reason is that if the gas price is high, then it's costly for other people to push the price back to the equilibrium price. So if the gas fees are expensive, then it takes a longer time to adjust the price back to equilibrium. Versus on the other exchanges, we see a negative impact on gas prices. And that is because the other exchange, if the gas price is high, people don't want to transact. And so therefore the arbitrageurs are less likely to come in and push the price on the other exchanges down so that the exchange prices match up again between the exchange where the loan was liquidated and the other exchanges. So, but kind of the main takeaway that we see here is that this contagion effect is there, that we see that all the other exchanges are affected by these loan liquidations. So we have kind of lasting price impact, but we also have can see that the other exchanges are affected by these loan liquidations. So what is the implications for returns? So we look at 2 million 5-minute returns in our sample on 36 exchanges. We look at all the tokens that ever were collateral in one of the loans. We look at the liquidation returns, and we define that as a return where there was at least one liquidation in this 5-minute interval that we're looking at. And we choose 5 minutes because 5 minutes is long enough for the arbitrageurs to push the price back. So if there was indeed a short-term deviation from the fundamental because of the loan liquidation, but this was very short lasting, then the arbitrageurs can push the price back. But we also want to make sure that we don't choose a too long time period so that on a given day, we have intervals of time where there was a price loan liquidations for next to price intervals where there was no liquidation, so that we can have kind of control for any fundamental effects or news that came out on the token on a given day. So here's how the graph looks like. So we see here where no loan liquidations happen is the blue line, and the orange line shows you where the loan liquidations happen. And we see the fat tails of the distribution for those returns that are associated with loan liquidations. So this is kind of interesting because we can see that for these loan liquidations pose some kind of risk for these just ordinary investors who just hold the tokens, maybe for other reasons, maybe for investment reasons or whatever. But there's this spillover effect that these loan liquidations generate risks for these investors who just happen to hold the token because they change the return distribution. Specifically, these more extreme returns are more likely just because of these loan liquidations. So these loan liquidations generate the real risk for investors. So we also can look at price impact in terms of in the context of these loan liquidation waves. So if we have, for example, we look again at the return over kind of a short period of time, but look, if there's a price impact, and how much of that return is explained by the liquidating swap. So if we have a single liquidation, then we see that the liquidation swap does not really matter. Why? Because this is a one-off loan liquidation. The liquidator sells the collateral, and then some arbitrageur comes in and pushes the price right back, and so there's no damage done, no statistically significant impact here. But if we have multiple liquidations, then it gets interesting, because here we see that the liquidating swap has a lot of explanatory power on the return of the token in the medium term. So these swaps matter in these liquidation waves. So one thing that is still very preliminary that we want to look at is predatory liquidations. So we want to look at, are these liquidators really just sitting there and waiting for the loans to be liquidated, or are they actively pushing loans over the edge? So at the moment, I just have one example, and I've not done the more rigorous kind of analysis for the whole sample, but there's one example of kind of an attack for this to happen. So Compound, for example, uses a price feed from Coinbase, or used a price feed from Coinbase, and the price feed from Coinbase was kind of flawed because some attacker pushed the price of the DAI stablecoin to $1.30. So since it's a stablecoin, it should always be worth $1, but this was pushed up to $1.30. So therefore, some Compound positions seemed under-collateralized, and $130 million in loans got liquidated. So this is kind of one type of predatory attack where the attacker knew what kind of price feed the platform is using and then targeted that price feed. But the other thing we are looking at here is a different type of predatory liquidation. So if the loan is close to the liquidation boundary, the liquidator could potentially really try to push the loan over the edge into liquidation territory. So the liquidation that happens then causes a price drop, as we documented, and that causes further liquidations to happen. So we really we cannot just wait for this kind of negative feedback loop to develop. The liquidators can take an active role and really initiate that. So at the moment, I just have a case study. So on May 1921, there was 147 loans with Bitcoin as collateral. About $64 million in loans were liquidated. And what we can see is we can trace these, we can look at the liquidators, so who did the liquidations, and we can see what these liquidators were doing before the start of the liquidation wave. Because everything is public on the blockchain, we can really trace the same people back and see what they were doing before the liquidation wave started. So here's a picture. So we see the liquidation wave. So here is the relative time of blocks. So here is 0. This is when the first loan liquidation happened. And we see that it starts slowly and then it gains momentum. And there's again a huge liquidation wave here happening. So that's the kind of gray area. So what you see here in the blue line is the cumulative purchase of sale of tokens by these liquidators. So what were these liquidators trading? And we can see that here before the liquidation wave starts at time 0, before that these liquidators were shorting about $500,000 worth of the collateral. So they were selling the collateral, and I looked at this a little bit on Etherscan, and they were selling the collateral to smaller decentralized exchanges where they could really impact the price on that exchange. And so if the Oracle uses, for example, these kind of smaller exchanges too, and gives them an equal weight with the larger exchanges, then well, we can see that the Oracle updates that the price decreases a lot. So this is some kind of evidence that they really try to push the price downwards before the loan liquidation happens actively. So we can see that they were successful. The orange line here shows you the price of the collateral, and the price of the collateral that goes with the right axis dropped quite a bit over that period of time. Now, it's hard to say whether it is only due to the liquidator selling, but certainly the selling $500,000 worth of collateral has some kind of price impact in this ecosystem. And then we can see that as the liquidation wave starts, of course, the price of the collateral drops a lot, as we see before, and then the liquidators start buying. So when the price of the collateral goes down a lot, we see here the blue line here, we see that these liquidators now start buying and the collateral token. And so they build up a position in the collateral token when the price is low, and then kind of they continue buying here as the price of the collateral goes up again once the liquidation wave is over. So it seems like there's really some kind of predatory behavior by these liquidators in these financial markets. But as I said, this is just a one-time example, and we are working at the moment on a more rigorous study. So in this paper, we want to document some systemic fragility in decentralized markets. I hope I could convince you that we have some robust evidence on this existence of these feedback loops. But not only is the problems within these kind of DeFi lending platforms, this affects the return distribution of assets in a broader sense, and therefore affects a lot of other people that are outside of this DeFi lending space. So we see here transmission from risk from lenders to the traders of these assets. And I think this is very useful because in the repo market or places like this, we are concerned about spillover effects and feedback loops and systemic risk. And when CBDC is on the horizon, then we see that this will become more prominent to use smart contracts. And this is something to potentially watch out for. There's also systemic risk in these decentralized systems. So thank you very much. And I think my time is up.
Okay, yeah. Thank you very much for this presentation. And we do have some time for questions. So there is one from Thomas.
Again, very interesting. So I something I'm trying to wrap my head around, which is why you have some liquidations for the same loan collateral pair, but not others. So I'm guessing there's some heterogeneity. I know that all these loans are over collateralized, but so my thought was that as soon as one of the loans, the collateral constraints is violated for one of the loans, all of them get liquidated because they're all the collateral constraints are binding. But I guess if that's not the case, then some users are choosing to voluntarily over collateralize above the constraints set by the protocol.
Yes, so we find that most users are typically well above the constraint for most time. And that's rational because you cannot monitor your blockchain all the time, right? So position all the time. So you want to have, say, have a collateral factor of 1.5 or something, and then you don't risk that when you don't pay attention that there's a blip in the price and you get liquidated, right?
Right.
So,
okay. Yeah, very, very interesting. Thank you.
You're welcome.
Yeah, sorry.
So I have a question. So in terms of the way these loans are set up, so my understanding of, say, Compound was that the collateral wasn't necessarily exactly matched to what it is that I'm borrowing. So for example, if I go on the app for it, like there's this lever where I can, for any position I have deposited, I can sort of toggle it. And I think it calls this enter markets function that says I'm going to pledge as collateral that particular holding.
Mhm.
And so my understanding was that sort of the specific. So if I go and let's say borrow, so let's say I deposit Ether and wrap Bitcoin, and I go borrow some DAI. I didn't see where, at least through the app, that sort of my borrowing of DAI would be directly tied to, let's say, either my collateral on Ether or wrap Bitcoin. And my